Weekly digest of the biggest market stories from the past week. Join host Serin and financial expert Bruce Campbell as they go beyond the headlines to deliver cutting-edge insights into news that move the market. Proudly presented by the Canadian Securities Exchange.
Hi, my name's Serin, and I'm Director of Listings Development with the Canadian Securities Exchange. You're joining us here for yet another market recap on Friday, June 17th, 2022. I am joined by my wonderful co-host, Jordan Youl, with Stonecastle Investment Management. At this point, Jordan, I'm calling you my co-host because I get to see you just as often as I see Bruce now.
Right. Yeah, no, it's good to be back for sure.
Last week I poked fun at him for missing me and he had stone face. And I actually have to tell you, I had a few people comment on it. So there are people that watch the show and that's what they commented on, not all of the wonderful, amazing news we tell them. But it's good to know that there are people out there who watch it. Thank you so much for joining me, Jordan. I can't believe that we're on the second half of June already. But of course, you're also joining us because it's a very special day for you and I. You're always with us on Quadruple Witching Day. So we're going to talk about that. But let's jump into it. We're going to talk about Fed hikes yet again, how much, what it did, and what we can expect going forward. We're going to talk about Quadruple Witching Day. We'll remind you what that is, what that means for the market. Then we're going to talk about a bunch of selling that's happening in the market. And then, of course, we'll end off with CSE issuer news. So why don't we start off by talking about what happened with the Fed this week?
Yeah, so, it kind of translates into what happened at the end of last week with the CPI numbers. They came in a lot higher than expected, and that kind of forced the Fed to actually increase rates 75 basis points on Wednesday. The market and investors were anticipating a 50 basis point hike. So it really kind of caught the market off guard a little bit. Jay Powell's been quite transparent in terms of, what the expectation is for rate hikes. We knew that the Fed was going to hike this week, but the market was anticipating only 50 basis points. So the market, gapped up and gapped down, but we do have a chart just showing like how rare it is. It doesn't happen very often, but effectively over the last 100 years, this is the 8th time that the Fed has increased rates 75 basis points. And the last time this occurred was actually in 1994. So it doesn't happen very often. The chart on the right-hand side is the implied probability of the next meeting, which is in about 40 days in July. And what's really interesting is that the market is anticipating an additional 75 basis point hike in July. And in the very bottom right-hand corner of that table, of the chart on the right-hand side, 1 month ago, the market was only expecting 1.5% of the market was anticipating only a 75 basis point hike. So the market is definitely anticipating that the Fed is going to be more aggressive with their rate hikes moving forward.
Okay, so I was reading up a little bit on it. It was saying that experts are saying interest rates are still way too low. There's still more that needs to happen and that Canada will follow suit. Is that what you expect?
Yeah, without question. And we've been talking about this for several months now and been pretty telegraphed that, the Fed has been behind the curve. This time last year, the Fed was communicating to the market that inflation was going to be transitory or just temporary. And obviously that's not reality. And, inflation's hitting multi-decade highs and, we're seeing it, in our daily lives, right? Whether it's at the grocery store, gas station, we know people that have gone from 2 cars to 1 car just because of the rising costs of goods, that are affecting and impacting everybody's day-to-day lives. So without question, we're expecting, rates to increase moving forward. This is not just a US narrative, but it's global, right? We're going to see it in Europe, Asia, and at home here in Canada.
Absolutely. I feel like this has been creeping on for some time, but it really does feel like it hit us overnight. I don't know about you, but I feel like I see it, kind of in an overnight situation, but it has been going for a while. So hopefully they can keep that at bay. Okay, let's talk about Quadruple Witching Day. So I guess the first time you were with us, it happened to be Quadruple Witching Day, and you've joined us every time since. Just to remind our viewers, Quadruple Witching is a date on which it happens 4 times a year, every quarter on a Friday. It's a date on which derivatives of stock index futures, stock index options, stock options, and single stock futures expire simultaneously. The event occurs in March, June, September, and December. So what does that mean for the market when this happens?
Yeah, so what you can expect is an increase in volatility and volume, especially going into the close today, because traders, large pools of capital, fund companies, and what have you, are making adjustments today. So a lot of these contracts are expiring, or they have to meet obligations, and they're readjusting their allocations. So it doesn't happen very often. Today it's quadruple witching, so effectively everything expires today. So really what typically happens is we see an uptick in market volatility going into the close, and we actually do have a relative rotation graph of the U.S. indices in the U.S. The Dow, the S&P, the Russell 2000, and the Nasdaq. Those are the green lines in the relative rotation graph. If you're not familiar with how the RRGs work, there's 4 quadrants: improving, leading, weakening, and lagging. And what's really important is you want to look at the tails, those squiggly lines in the relative rotation graph, because they typically rotate in a clockwise fashion. And the takeaway here is that the market is anticipating that we're going to see an uptick in volatility over the weeks ahead. So week over week, we've seen an uptick in market volatility. The VIX is above 30 today, but we are expecting the equity markets to be more volatile in the weeks ahead. And then that squiggly line in the lagging quadrant, which is red, that is actually a derivative of the VIX index in the US, and it's actually tracking the volatility of the VIX index. So what it's indicating is that we are seeing an elevation in volatility, but the expectation is that it's going to be more volatile over the next few weeks for sure. So investors just need to be prepared for the expectation that markets could go up and down by quite a bit.
There's a lot that investors have to be prepared for right now, I feel like. Okay, on that note, we're going to talk about equity selling. So, is bear selling in control? The stocks have officially entered into a bear market, and experts are predicting that a potential recession is around the corner. So what are we seeing in the selling arena?
Yeah, so this is really interesting. At Stonecastle, we like to look at a variety of different breadth metrics to determine the strength of the equity markets. And we do have a chart which is showing the percentage of stocks in the US trading above their 50-day moving average. And you can see on the far right-hand side, we're at 1.6%. So in other words, the majority of the constituents that represent the S&P 500 are trading below their 50-day moving average. And this doesn't happen very often. The last time this occurred was in the March 2020 low during COVID. Previous corrections were in 2011, the financial crisis in 2008, and the bear market in the early 2000s. So this is where we're at effective today. Again, it doesn't happen very often. It is quite significant. Typically what happens is when sentiment is so pessimistic from a contrarian standpoint, it is positive and constructive, but the concern is that, we are in this bear market, our long-term indicators remain negative. So I wouldn't be surprised if we see a bounce or a counter trend rally, maybe next week or the week after. But, we don't know if this is just going to be like a dead cat bounce or it's just going to be a bear market rally, because again, the longer term trend and narrative is still pretty concerning and negative at this point. So sentiment is completely washed out. It's a little bit difficult from a timing perspective, but again, I wouldn't be surprised if we get some type of counter trend or relief rally in the next couple of days or the next couple of weeks.
Okay, so correct me if I'm wrong, but the bear market is officially considered when it's 20% off of its highs, right?
Yeah.
But we don't know how long it can last 20% off. So we've seen, I think in the past few decades, we've seen 14 bear markets. Do you, in your and Bruce's practice, as you guys look at kind of what's going on in the state of the economy, any thoughts on how long we might be in this?
Yeah, so it really depends. But, for example, the US LEI index came out today, and that's a really good gauge or proxy that tracks a lot of different factors of the economy in the US. And one of those constituents is the S&P 500. That's a factor in that index. And that came out and was released this morning. And month over month, it's been negative. So We could be in this bear market or contractionary phase for several months. We are going to be going into a midterm election in the fall as well, and that could be a potential catalyst to maybe turn things around. But being completely objective in the work that we do, what is concerning is that we're seeing intermediate and long-term indicators turn negative for the first time that we haven't seen since 2020 and other bear markets. And again, this is happening right now. So it could be multiple quarters before we get a reacceleration into the equity markets. But again, we'd like to break out of this downtrend that we've been in since the peak, really depending on what indices you're tracking or following.
Right. Well, we'll keep watching. Of course, we're going to end off with some CSE issuer news. I had the pleasure of being in Toronto this week. Jordan, it is in the mid-20s there. I don't know what Kelowna is doing, but that is not the weather we're getting in Vancouver. It was a joy to be at PDAC in June, where there was sunlight and warmth, and I hope that they carry on that tradition. But I wanted to chat with you a little bit. I mean, we've kind of come off of VRIC in Vancouver and PDAC in Toronto. PDAC had a record-breaking registration. You'd never know that COVID was an issue because every room was as full as it could get. Tons of issuers, tons of money being raised. We just talked about, the terrible state of the markets, but the event that I was just at, it was pretty hard to tell that was going on. I also wanted to mention that, I took a look at some of our new issuers that have come to the CSE, and I'm going to say a shout out to all of them. It'll take me a second here, but they're all in the mining space. Then we're going to talk about the junior space and what we're seeing based on everything we talked about today. So welcome, Copper Ridge, G2 Energy Corp, Mesa 2 Resources, Clear Sky Lithium, Great Republic Mining, Madison Metals, Future Fuel Energy, Acme Gold Company, Golden Sun Mining Corp, Mayo Lake Minerals, Ashley Gold Corp, Talent Infinity Resource Development, Prudent Minerals Corp, and Beyond Minerals Inc. I'm pretty much talking about the past month, and that's all mining issuers. We have other issuers that have joined us. These are junior mining issuers. So why are we seeing this in the junior mining section right now?
Yeah, well, quite a few reasons. We've touched on this a few times over the last year, but we believe we're in a new commodity super cycle where effectively Toronto is potentially poised to outperform the U.S. moving forward after underperforming the U.S. for the last decade or so. We're seeing emerging markets, a lot of these commodity-rich regions outperforming the U.S. for the first time since the early 2000s. But for new ideas, we're looking at commodities ourselves. We've done well on the energy side, but what's been kind of lagging has been the junior gold miners and precious metal miners. And we are starting to see them improve in our models. So that's where we're focusing on for new ideas. But obviously with rising costs, inflationary pressures, we're seeing a lot of opportunity in the commodity universe. And obviously that kind of coincides with the junior gold miners right now. And, that'll benefit the TSX and the CSE and the TSX Venture Index just because of the weighting of those, benchmarks, right? We are heavily focused towards natural resources and commodities. So, given the fact that we do have this commodity tailwind and we're at levels we haven't seen in many years, we really think there's this very strong opportunity set for investors to look at, these junior miners for new ideas moving forward.
Well, and listen, I mean, a lot of the exchanges in Canada and a lot of the Canadian capital markets are made up of junior exploration and junior mining companies. And Canada has become a global leader as far as the junior exploration space. You're listed in Canada, but most of the projects are found all around the globe. The thing I love about this is that when we see this type of market happening for the junior exploration is the most important element, which is money flowing to it. And really as a society, we only need more and more commodities. We need more technology around mining. We need general capital to flow to the sector. So this is exciting for me that money is flowing to the sector in general, right?
Yeah, absolutely. And our expectation is we'll continue to see more financings. Like bought deals, private placements, IPOs, things like that, some M&A activities. So without question, it's going to create a lot of opportunities to try and make money in this environment.
Absolutely. Okay, Jordan, what should we think about going into next week?
Next week, there's a lot of economic data on the table. Jay Powell's testifying next week as well. I really believe that the market after today's close is really going to try and digest, some of these market indicators. I wouldn't be surprised if we see a counter trend rally or bounce or relief rally next week, which could be opportunistic, especially if you're an investor and you're looking at trying to get off a position. You can potentially sell on strength, or you can free up cash flow and look at deploying that capital into some new areas like junior miners, for example, for new ideas that look a little bit more constructive. So it'll be really interesting. But obviously we're going to just take in the data every single day and put it in our models. But effectively, what we'd like to see is a transition from more of a neutral defensive macro backdrop to more of an offensive picture. And we touched on that a couple of weeks ago, where our macro risk assessment model was kind of going in a negative direction. So we like to see the needle move in the other direction effectively before we get really optimistic and positive on the equity markets. So we're just going to take it day by day, but I wouldn't be surprised if we get a relief rally, given the fact that sentiment is so washed out and pessimistic right now.
Amazing. Well, listen, it's always great to see you. Of course, it's Quadruple Witching Day. I hope you have a wonderful weekend, and thank you again for everything, Jordan.
Yeah, thanks for having me.